And in particular, when I buy an overvalued asset, what I run is the risk of the permanent impairment of capital. And people constantly get the definition of risk wrong. They think it's standard deviation, they think it's beta, they think it's value at risk. Risk is not a number. Risk is a concept. It is the permanent impairment of capital, the chance of seeing your capital damaged in such a way that it's going to take you pretty much forever to get it back. And buying overvalued assets is one of the primary routes to suffering the permanent impairment of capital. So what we've got here are forecast real returns on the axis up the top here, and the steepest drawdown witnessed in the subsequent 3 years from the point at which the forecasts were made. What you find is these points drift downwards to the left. Effectively, this is the margin of safety at work. When you buy an asset that has, let's say, below 5 in terms of its expected return, then you are looking at a potentially very nasty outcome in terms of drawdown. Bearing in mind, buying at 0, which is where we were just a few months ago, you could easily see your money halve. Buying at 3, where we are today, you're still very much in this negative area. As we move upwards and to the right, you'll see the drawdowns you tend to suffer when you buy cheaper assets get lower and lower. That is just the margin of safety at work. That's the very essence of value investing. Now, there's a response to those kind of drawdowns, which is all about tail risk. And tail risk is something that interests me greatly, because I think it's one of those concepts that people are intrinsically fascinated by. It sounds sexy, tail risk, I run a tail risk protection fund. But what does it actually mean? Well, back when I was at school a long time ago, I had a logic teacher, and his first question, anytime anybody ever said anything, was define your terms. And I think that's what tail risk funds often fail to do. They simply do not define their terms. What tails are they actually protecting against? Is it an illiquidity event? Is it an insolvency event? Is it inflation? Is it deflation? There are a myriad of potential tails you may wish to hedge. But which ones are you actually worried about? Which ones are you trying to hedge? So when you're talking about tail risk insurance, the first thing to say is, okay, which ones are you actually worried about? Start with that question and work from there. Question 2 is, why are you actually hedging? Because an awful lot of people who seem to want tail risk insurance seem to me to be motivated by greed rather than fear. By which I mean what they're really trying to do is harvest risk premiums when their risk premiums are simply too narrow. And there is a much cleaner alternative to that, which is when risk premiums get narrow, step away from the market. Just don't transact, don't get involved. No one puts a gun to your head and forces you to be fully invested, or at least not in my world. So why would you want to do it? And the answer is you'd have to be greedy. You're having to try and harvest every tiny slither of return you can. Now, there are some legitimate reasons why you might want tail risk. You might say, well, the particular portfolio I hold is more illiquid than everybody else's, and therefore I have greater need of tail risk protection. But it can't be true in aggregate. So I think one has to examine the motives for tail risk hedging quite closely. Question 3 is, how will you actually go about hedging your tail risk? And there are 3 basic categories of devices that one can use to try and hedge tail risk. The sexy one are the contingent claims, CDOs, etc., CDS. All of these things are fascinating, exciting, and occasionally they do get thrown up as byproduct from market mania. When the market continuously misprices something, we can find we can get cheap insurance on contingent claims. But the problem with contingent claims is they can be dangerously over-engineered. It is very easy to buy fire insurance in Chicago as long as the fire is started on a Thursday night by a cow. I can also guarantee it will probably never pay out. It won't cost you much, it'll be pretty cheap, but you'll just be throwing the money away. So over-engineering is always a worry when you're dealing with contingent claims. The second approach is to find strategies that are anti-correlated with whatever the risk that you're particularly worried about actually is. So if we're talking about drawdown risk, market problem kind of risk, then you're looking at long volatility style strategies. Thirdly, there is the most underrated aspect of tail risk hedging, which is something deeply unfashionable, known as cash. Cash absolutely pays you no return. It sucks. I hate holding cash. But as Warren Buffett said, holding cash is unpleasant, but not as unpleasant as doing something stupid. And a lot of the time, I think it actually makes sense to hold cash. It's dry powder. It allows you to exploit different opportunity sets. And that's something that I think people don't often think about. So question 4 is then, who will you actually buy this tail risk product from? And that's one that doesn't get a lot of press. If you think about it, who should be the natural sellers of tail risk? Arguably, it should be very long-term pools of capital, pension funds, endowments. Who actually sells tail risk insurance? Investment banks. When the shit hits the fan, do you really think investment banks are going to be able to pay out on tail risk protection? I'm far less convinced. So why on earth would I want to buy insurance from someone who may well not be around to pay that insurance out? So there's an oddity in the tail risk market where the natural sellers are actually buyers and the natural buyers are the sellers. That's a pretty perverse dynamic. The final question you have to ask yourself if you're going to hedge in tail risk land is, how much tail risk protection do you actually need? And it turns out in a lot of samples you need a lot more than people imagine. People seem to think, oh well, I'll just put 5% of my portfolio in tail risk protection, it'll all be fine. That doesn't even begin to get close to the kind of numbers you actually need. So let me give you a couple of charts to explain some of those points. Here we've got the best example I could possibly have imagined, thankfully drawn after I'd written my paper on tail risk. What I'd argued was there is a problem that insurance is as much a value proposition as anything else we do. You want cheap insurance. You don't want expensive insurance, because expensive insurance will not pay out in the way you want it to. And that's exactly what we saw in the last few months. So volatility, VIX, effectively the blue line, spiked massively. The payout to a long volatility strategy in terms of rolling VIX futures was pathetic. It just didn't kick in. Why? Because the term structure was enormously steep. You were massively overpaying for the tail risk, the long volatility stance that you were adopting. And strangely enough, if you overpay, you get low returns. And that's exactly what happened. Now, I mentioned that there was an alternative to some of these approaches, strategies that are anti-correlated with the risks you're worried about. And one of the examples that I came across was actually being long high-quality stocks and short junk stocks. And that does pay out in the way that you would expect. Bear in mind, you remember that VIX chart from the previous page. That spike is exactly what we saw in VIX. This is the total return to the long volatility strategy of futures. You get a very different payout. So thinking very carefully about how you implement tail risk protection really does matter. In terms of how much protection you actually need, I did a little simulation saying, okay, let's imagine I wanted to have a zero drawdown at the trough in the market of March 09. How much tail risk protection did I actually need to achieve that? Well, I ended up needing to put 30% of my portfolio into tail risk products. That's an enormously high amount of your portfolio in something that, frankly, is insurance and therefore generally has negative expected value. A much better strategy was actually just to hold more cash, to behave in a more conservative fashion, just to keep 25% of that money in cash. And of course, this doesn't allow us to exploit the opportunities in the way that one actually would. We weren't taking down cash when the market fell. Here I'm keeping a constant cash. But even that did much, much better than a lot of the tail risk product ideas. Tail risk is really just about deferred underperformance. Sure, you don't get the drawdown at the point at which everyone else was suffering, but of course you then bleed out the rest of the time. Why? Because it's expensive. So why hold cash? Because cash is dry powder. It allows you to transform today's opportunity set into tomorrow's. And that quote there from Seth Klarman is one of my all-time favorites. Why should the immediate opportunity set be the only one considered when tomorrow's may be considerably more fertile than today's? And that's exactly the kind of philosophy I think that people should have. So the yellow bars here are the return forecasts that we had in real time in September 2007. Pretty much everything sucked. There was nothing that was attractive. Even high quality, which we usually like, was only yielding a 2.2 real forecast. So everything was expensive. That's a perfect world in which you should say, look, I'm not getting paid for taking on risk. I really shouldn't do it. I should pull my horns in. I should hold lots of cash and wait. And sure enough, by February 2009, you had a plethora of cheap assets. Didn't matter what you bought so long as you bought something. Lots and lots of assets at compelling valuations. Where are we today? Well, kind of somewhere between the two. Arguably, in some of these markets, a bit closer to the blue than the yellow. In others, somewhat closer to the yellow than the blue. But that is the set that we face today, those green bars. They're the same forecasts I showed you earlier for the equity markets. Now, people often say, well, surely cash sucks. I mean, particularly in a potential inflation environment. But cash actually generally is not a bad hedge against inflation. It's not perfect, and in today's world with Bernanke and co at the Fed, it is probably less useful than it ever has been as an inflation hedge, since they're telling us they're going to keep rates low. But actually, if you go back and look at the 1970s, what you find is cash actually did remarkably well. It held its own, pretty much, in real terms. So despite incredibly high inflation, cash just tracked sideways. Why? Because people were raising short rates. So as long as the central banks behave in a way that is consistent with trying to bring down future inflation, cash is a reasonable hedge against inflation. In a world in which the central bank is not trying to do that, arguably this is something one wouldn't want to rely on quite as heavily. Equally, one can ask, well, how does cash do in deflation? Well, look at the Japanese experience. And yet again, cash actually does okay. Equities suck in a deflationary world. Deflation tends to strip mine out the very essence of asset values that lie behind equities, so they tend to do very badly. Of course, bonds do even better than cash. But in order to know that, I would have to know the future. And one of the great obsessions in finance is with optimality. I do not believe optimality can exist in any meaningful sense apart from in an ex post world. Ex post, you can tell me what would have been optimal. Fine. Ex ante, you haven't got a clue. So rather than building optimal portfolios, what you've got to try and do is build robust portfolios. Portfolios that generally can survive multiple environments. And cash actually fulfills that role better than bonds do. In an inflationary environment, we know bonds get crushed. Deflation, they do much better, but cash actually does okay in both. So cash is a much more robust asset class than bonds. In fact, if you look at the very long-term history of bond rates, bond returns and cash returns, they're actually incredibly similar up until about 1982, when bonds go on an enormous tear and do fabulously well. But up until then, you got very little extra return from holding bonds. So cash, I think, is a much more sensible, robust asset class to want to hide in than bonds. So holding cash is uncomfortable, but it's the right thing to do. It preserves capital, it acts as a tail hedge, it allows investment flexibility, and it's a reasonable inflation and deflation hedge. However, cash should generally be a residual. When I do asset allocation, I don't sit out and think, okay, I want X% of my portfolio in cash. I sit there and think, how much do I want to invest in the opportunities that are available, and then whatever gets left over goes into cash. Cash is just the default residual number that I'm left with.